Welcome to the QSBI ESG podcast. Today we're joined by Shirish, Associate Director of ESG Risk Management and Oversight at a leading Canadian bank. Hey Shirish,
Hey Angshi, hey Maliha, how are you?
we're doing well. Thank you for joining us today. To start it off, could you please give a brief introduction and just share a snapshot of your journey from engineering to finance?
Yeah, absolutely. First of all, thank you so much for having me here. I originally come from Bangalore in southern India. I did my undergrad in industrial engineering there, and then I moved to Canada, did my MBA at McMaster University, after which I've been working in the financial services space.
It's great to hear. Before we dive in, today's episode is going to explore some of the core instruments shaping sustainable finance, such as green bonds, transition bonds, blue bonds, and sustainability linked loans. So, at a high level, green bonds fund environmentally beneficial projects, transition bonds help high emitting sectors move towards lower carbon operations. Blue bonds support ocean and freshwater conservation, and sustainability linked loans have financial terms that adjust based on a borrower's progress towards ESG targets. So, kind of diving right in, could you walk us through the products you've worked most closely with and kind of explain the specific problems or market gaps that they're designed to address?
Well, so before we begin, I'd just like to state that whatever I share today in this episode are my views and my opinions only, not to be affiliated with that of my employers or other entities. Once that's out of the way, I can get into the question. So in terms of the kind of products that I have been usually involved with are in the lending sphere. Within the sustainable finance sphere, you have bonds and loans. You have various called GSS bonds, which are green, social, and sustainability bonds. There are sustainability linked bonds as well. And then there are subsets within each of those. Within the green bond sphere, you have the blue bonds, which are specifically focused on the marine ecosystems and oceans, etc. We have climate resilience bonds, which are a new feature given erratic weather events, etc. You also have catastrophe bonds, which are another sort of new innovation, and a lot of insurance companies are looking at it in terms of setting aside financing for specific catastrophes and unlocking that capital when if any unfortunate event happens of that sort. Within the loan sphere, you have a similar GSS. I would say that sustainability bond is not directly within the loan sphere, but it's more sustainability linked SLLs. There are two types of those products. You have use of proceeds bonds or loans, which are allocation of capital towards green or social based projects or activities. And then you have the other side for the sustainability linked, which are mostly incentive based products. And again, that is where a lot of banking and financial institutions operate within. If a borrower takes up a green loan, the proceeds from that loan go towards greenification of their operations. It could be a wide variety. It also sort of talks towards how the project selections themselves are done. There's more about verification and reporting, more sort of governance related aspects to that. From the sustainability linked loan sides, you have incentive based products which offer borrowers either a discount on achieving some targets within stated KPIs, or they help them achieve their own sustainability goals, become more resilient in the face of market variations or the macroeconomic changes and policy shifts. And also the penalty which is applied. That would be if the targets are not met, then there is a certain level of addition to the interest rate that the borrower ends up paying.
I wanted to ask maybe more about sustainability linked loans as well as green loans. What do you think is the key thing that makes them technically effective rather than just on paper seemingly like they would work?
I would say robust governance. Robust governance would be applicable to all players. It would be on the part of not just the lenders, the borrowers, industry regulators. And by that, I don't mean overregulation, but an appropriate level of regulation, because overregulation will kill anything and everything. We are seeing a lot of that in the EU. I think the governance aspect is key to ensure, from a lender perspective, strong internal bank reviews of these facilities. From an issuer perspective, having those internal mechanisms for governance within the companies, getting third party external verifications which confirm authenticity and alignment to the company's own sort of strategic plan, and just broader ambitiousness within targets for the KPIs for SLLs, but ambitiousness even within use of proceeds projects that will be used via green bonds.
I'm really curious what kind of financial products or structures you think are going to become more mainstream eventually that today we still consider to be really innovative?
I think there's a lot going on in this market, which I get excited about. Top two of mine, I would say maybe transition loans are something which I'm really excited about, given the context of where we are today and the need for companies which are, quite frankly, have a lot of answering to do to multiple stakeholders. They have their employees, they have customers, they have investors, social advocacy groups, communities, etc. So you have a long list, and sometimes these demands from these various stakeholders are opposing. And so it's a very difficult being able to sort of meet all those demands. And so I would say transition loans are an added tool within the toolkit. They help, especially a lot of the hard to abate sectors and companies within those sectors to utilize those loans. It's a combination. Essentially, it's a combo package. You can use SLLs, you can use of proceeds. There have been newly released transition loans guidance in October from the LSTA and LMA, which talk more to them. But the principles themselves focus on use of proceeds. So specific transition oriented projects which help, let's say, fuel reswitching within some sort of power utility, or making sure that they transition towards a lower carbon fuel, or changing machinery towards much more in the steel sector, so electric arc furnaces and so on. We also have the Canadian taxonomy, which focuses on transition, which I'm hugely anticipating. So we have seen some commentary within the budget that it is supposed to come in. The broader theme is that is an area which sort of augments and supports broader sustainable finance objectives and products. Something else, and very quickly within the banking sphere, there's been another bond product which is specifically not for corporates, but it's actually meant for financial institutions. It's called a sustainability linked loan financing bond, SLLBs, which are for financial institutions to issue these bonds for essentially financing a lot more SLLs. And those SLLs will be public. If it's to be a public issuance itself, which it will most likely be, then the financial institution will be publicly putting out the examples of SLLs that they have financed with KPIs, with targets, etc. And that has been another criticism of SLLs, where these are usually obviously private loans, and so not a lot of information is out there. And that will help create that database for integrity purposes, for ensuring a lot more folks can understand and tap into such ideas, let's call them.
Very cool. I think it's so interesting, especially for the transition bonds and transition loans that you mentioned, it being able to target the industries that traditionally wouldn't even be involved or interested in ESG. Like I know you mentioned machinery, things like that. I was kind of curious if you hold any contrarian views about the direction that sustainable finance is going.
I have both in under discussed as well as contrarian. So for the
Right.
under discussed area, I would think that sustainable finance products should be viewed currently with the sphere of risk management and not just impact. So the impact is a longer term, perhaps even medium term objective. In the short term, of course, anyone would be satisfied with impact within the short term if that is measurable, with smart targets and so on. That philosophy where we are looking at real world emission reductions for environment or social contributions with respect to, let's say, affordable housing, with respect to food security, etc. But the main focus, in my view, with sustainable finance and broader transition finance would be that short to medium term risk reduction, said transition or said greenification or social advancement of the product's intention. The contrarian view would be, I think that we are in a state today in the world where there's a lot of partisan, emotions attached with ESG. The word itself has become a bit of a controversy. So I would think that ESG and broader sustainability needs to be nonpartisan. We need to get back to basics. I'm fully bullish on this, but I think we will see a huge rejuvenation within the sustainable finance industry in the coming years, especially as we see the impacts of current regulatory shifts and current geopolitical environments. It would dawn upon a lot of participants that by 2030, or beyond that, we have a lot of work to be done and we'll need to pull up our socks and our sleeves. At that point of time, I fully believe that this will become mainstream more than right now. And I think it will be a critical part of every company's financial institutions toolkit, and it will be very much general, and it will be, I would say, questionable if folks aren't using it.
Well, it sounds so great to hear as a student that's going into the workforce soon that, people are super bullish on this. So I see a lot of like regulatory change that seems to be shifting in the right direction. One of the last questions me and Maliha had for you as early professionals, as students, as these changes come and as the market shifts, where do you kind of see an opportunity for us to go in?
With the current sort of excitement over AI, which of course is the most talked about phenomena for a couple of years now. So sustainability and ESG will be part of pretty much everyday operations of corporates, of our own patterns and usages and so on. So that will never change. What does change is the way regulations will change, the way people's opinions will change, and the way that general market practices will mature even more. So for students, I would say that the conviction is important. If you firmly believe in that, I think that's going to take you, more than anything, farther along. And I think it would be, whatever area or specialty that you're pursuing right now, I think you will see that sustainability and ESG forms part of it, regardless. So I don't think there's an area where there is no application of sustainability at all, even within sports management. That's something that even I get excited about. We all love sports. So I feel like look for those areas which are currently underserved or under talked about, underutilized, and look for solutions or potential innovations popping up there or be part of that innovation. Within the finance sphere or broader traditional career options, I think this will be in the background right now, maybe, but it'll be at the forefront very much. So I would say stick to your guns and just look at what would you be happy with in creating that long-term impact beyond 2050. And once you retire, if you're happy or satisfied with what you've contributed, that's what drives me. And so I would like to share that.
Yeah, I think that's such an important reminder that if you're kind of steadfast and committed to sustainability, it's really can be found everywhere and can be applied everywhere. And with that, I think I'll say just thank you so much, Shirish, for taking the time to speak with us today. And thank you to everyone for listening, and stay tuned for next time.